What's going on, everybody? What's going on, everybody? Hope everybody is doing well today. Please bear with me as I get everything set up here. Hope everybody is doing well. You know, today was a very, very green day in the market. Extremely green day in the market. So it's always good to see green, but I want to make sure that we put everything into perspective. Make sure we really, truly put everything into perspective and see what's going on here. So yes, everybody, please bear with me as I get all this stuff sent out. Hope everybody was paying attention to what the Federal Reserve was giving us and the information they were giving us, because that's really truly going to be a big sticking point to see how we finish for the remainder of this year. All righty. Appreciate everybody for coming in. Appreciate everybody for tapping in to another episode. This is going to be an outstanding episode. I really want to let everybody know this is going to be an outstanding episode, and this is going to be extremely, extremely important for looking at the stock market and looking at how we need to view it and the mindset that we need to have around it for the remainder of this year, okay? Yes, I don't want to hold up everybody's time. I want to go ahead and get to it. So again, welcome back to another episode of the Trade for Yourself podcast, where my mission here is still very simple. I just want to help you learn how to trade and invest in the stock market for yourself. So please like the video. Please like, please subscribe. Please share with people. Look, everybody, make sure you hit that notification bell down there next to subscribe so you can be in the know every single time that I drop an episode. Okay, look, if you wanna get one of these t-shirts, don't pay for it, trade for it merch. Okay, please go to www.tradeforyourself.com, click catalog, click shop. That will allow you to see all of the merch and all the codes that I have. Look, we have free shipping on all orders. Free shipping on all orders. So please head on over there, get your t-shirts, get your merch, collect what you need to collect. All right. So let's examine what we need to talk about. Now, I'm not going to lie to you today. Today was one of those days to where, well, today was really one of those weeks, really, to where it was kind of difficult for me to decide what I was really going to talk about. I'm not going to lie to you. It was one of those days, one of those weeks to where it was kind of hard for me to decide what I wanted to talk about. But it came to me today. And so today we're going to talk about, I'm going to give you guys the game plan for how to attack the stock market for the remainder of 2022. Now, if you just bear with me and we go through the data, go through the economic data with what we need to see so I can explain everything to you, I will outline the game plan for how I'm attacking the stock market for the remainder of 2022 and how I think you may want to. Now, full disclosure, I am not a financial advisor. I am not a fiduciary. I do not manage money professionally. I am not an economist. Okay, I'm not. So please do your own research before investing into any stock. But this is just what I'm thinking in my mindset around the market and what it's given us. So let me go ahead and share my screen really quickly here. The first thing we're going to go over is, what did the Federal Reserve decide to do? Okay, what did the Federal Reserve decide to do today? Because this is going to be a major key. This is a major key, and it's very, very important for understanding what the game plan is for the remainder of 2022. Now, the Fed hikes interest rates by 0.75 percentage points or 75 basis points for the second consecutive time to fight inflation. The Federal Reserve on Wednesday enacted its second consecutive 0.75 percentage point rate increase, taking its benchmark rate to a range of 2.25% to 2.5%. Now that's neutral, all right? Chair Jerome Powell said there will be a point where the Fed starts to slow hikes to assess their impact. We actually think we need a period of growth below potential in order to create some slack. Now, let's go through this report. The Federal Reserve on Wednesday enacted its second consecutive 0.75 percentage point interest rate increase as it seeks to tamp down runaway inflation without creating a recession, which is going to be difficult. In taking the benchmark overnight borrowing rate up to a range of 2.25% to 2.5%, the moves in June and July represent the most stringent consecutive action since the Fed began using the overnight funds rate as the principal tool of monetary policy in the early 1990s. Now, let me explain why this is so important. The Federal Reserve, there are three types of monetary policy that the Federal Reserve uses. They use accommodative policy, they use neutral policy, and they use restrictive policy. At 2.25 and 2.5%, this is neutral policy. This is just where the Federal Reserve is just at neutral, has interest rates to a point to where they are not accommodative, nor are they restrictive. Now, while the Fed funds rate mostly directly impacts what banks charge each other for short-term loans, it feeds into a multitude of consumer products, such as adjustable mortgages, auto loans, and credit cards. The increase takes the funds rate to its highest level since December 2018. Markets largely expected the move after Fed officials telegraphed the increase in a series of statements since the June meeting. Stocks hit their highs after Fed chair left the door open about its next move at the September meeting, saying it would depend on the data. Central bankers have emphasized the importance of bringing down inflation if it means slowing the economy. Now, understand what Powell said. As the stance of monetary policy tightens further, it likely will become appropriate to slow the pace of increases while we assess how our cumulative policy adjustments are affecting the economy and inflation. Now, this is what I want everybody to understand. The stock market was very, very green today, partly because it was very green today. It doesn't mean it's going to be green tomorrow. It was green today because, number one, the market already knew we were raising 75 basis points. The market already knew the Fed was doing that. And Federal Chairman Jerome Powell, he left the door open saying that they may not be as aggressive in terms of raising interest rates. That's the thing. They may not be as aggressive in terms of raising rates. So that's very important. And they're going to let economic data decide, okay, what they're going to do. Now, let me tell you about this economic data that they're going to see. The Federal Reserve, they increase interest rates today in July. The next meeting, they will not have another meeting until near the end of September. So there's some important economic data that will come out before they have to decide what the next increase may be or if they increase. You will look at July inflation numbers. You will see July jobs numbers. You will see August inflation numbers. You will see August job numbers, and you will see September job numbers before the Fed even meets. That's really, truly going to decide whether or not the Fed is going to pretty much allow economic activity to be accommodative or restrictive. Now, I got a question in the chat. What is your main strategies making money in this market? Now, bear with me here. I'm going to give you the game plan for the remainder of this year. I'm going to give you what I'm thinking, what I'm planning on doing, what I'm betting on based on the data that's coming out. But I've got to get through this Federal Reserve economic data to give you some context into why I feel this way. Now, in the post-meeting statement, the rate-setting Federal Open Market Committee cautioned that recent indicators of spending and production have softened, which is what they want. Nonetheless, job gains have been robust in recent months, and the unemployment rate has remained low. It's actually historically low. Okay, the committee added using language similar to the June statement. Officials again described inflation as elevated and ascribed the situation to supply chain issues and higher prices for food and energy, along with broader price pressures. Powell said he does not think the economy is in recession, though growth was negative in the first quarter and was expected to be barely positive in the second quarter. Now, tomorrow morning, we're going to find out if we are technically in a recession. Okay, think about what a recession is, he says. It's a broad-based decline across many industries that's sustained more than a couple of months. This doesn't seem like that now, he said. The real reason is the labor market has been such a strong signal of economic strength that it makes you question the GDP data. The rate hike was approved unanimously in June. Kansas City Fed President Esther George dissented, advocating a slower course with a 0.5 percentage point increase. Now, I don't agree with that. The Fed needed to raise these interest rates and understand what they need to do to stop inflation. Now, look at this interesting chart right here. This is the federal funds target rate since July 2006. Okay, this right here affects monetary policy. Now, in 2006, the federal funds rate was at 5%. Okay, but as we got into the economic crisis, the Great Recession, the federal funds rate came all the way down to zero. 2008, 2009, before 2010, the Fed's target rate came down to 0%. Now, after 2015, that interest rate kept going up, and it got to 2.25 to 2.5%, which is where we are right now. Very neutral, very, very neutral policy. But in 2020, guess what happened? We came back down to 0%. Now, my traders on here understand what this pattern is looking like. My traders know exactly what this pattern looks like. This is looking like a double top right here. We are approaching a level of where we were back in December of 2018, January 2019. The federal funds rate, in my opinion, like I said before the start of this video, I am not an economist. Okay, I'm not an economist, but I don't believe the Fed's funds rate will get back up to 5%, because that would indicate very restrictive economic activity, and the economy wouldn't be able to operate the way it needs to operate. Remember, the Fed has two mandates. They have price stability and maximum employment. If you double the Fed funds rate from where it is right now, that's going to dampen employment, and unemployment is going to increase. So understand, like, where we at from an historical standpoint over the last 16 years from a federal funds rate standpoint. The Fed wants to be accommodated because they want economic activity to keep going. Now, the increases come in a year that begin with rates floating around zero, but which has seen a commonly cited inflation measure run at 9.1% annually. The Fed aims for inflation around 2%, though it adjusted the goal in 2020 to allow it to run a bit hotter in the interest of full and inclusive employment. The Fed said that it's strongly committed to reducing inflation and said that it could come with a cost to general economic growth and the labor market in particular. We think it is necessary to have growth slow down. Growth is going to be slowing down this year for a couple of reasons. The economy, he added, probably will grow below its long trend for a period of time. We actually think we need a period of growth below potential in order to create some slack. Now, understand this: just because the economy is growing below the trend line does not mean that the stock market is not going to increase. There are complicated factors that have to come together to understand why the stock market would increase, even if growth is underneath the long run trend for a period of time. In June, the unemployment rate held at 3.6%, close to full employment, but inflation, even by the Fed standard of core personal consumption expenditures, which was 4.7% in May, is well off target. Now we're going to get PCE inflation, That's going to come out on Friday. So we still have economic data coming out with Amazon, with Apple reporting earnings. Now, the effort to bring down inflation are not without risk. The U.S. economy is teetering on the brink of a recession as inflation slows consumer purchases and dents business activity. Now, the first quarter GDP declined about 1.6% annualized, and the markets are bracing for a reading on the second quarter is going to be released on tomorrow that could show consecutive declines, which is widely used as a barometer for a recession. Now, the estimate is that we have an increase of growth of 0.3%. I don't know what the number is going to be. I have no clue, but what I would say is that I wouldn't be surprised if we were negative and the market sold off as because of it. Because of it, I'm not sure what the market is going to do no matter what the number ends up becoming. Now, along with rate increases, the Fed is reducing the size of its asset holdings on its nearly $9 trillion balance sheet. Beginning in June, the Fed began allowing some of the proceeds from maturing bonds to roll off. Now, the reason why the Fed is allowing these bonds to roll off is because in case of a bad economic recession, the Federal Reserve still needs some cash and they need some dry powder on their balance sheet to be able to buy up some bonds, buy up some assets to be able to save the economy if they can, to use some of their tools. If they've already bought everything and they don't have any dry powder, they really can't come to a rescue. Now, the balance sheet has declined just 16 billion since the beginning of the roll-off, though the Fed set a cap of up to 47.5 billion that potentially could have been wound down. The cap will rise through the summer, eventually hitting 95 billion a month by September. The process is known in markets as quantitative tightening and is another mechanism the Fed uses to impact financial conditions. Now, if the Fed was purchasing bonds, that would be known as quantitative easing. That means they're lowering interest rates and buying up bonds. Quantitative tightening is raising interest rates and selling off bonds. Now, along with the accelerated balance sheet runoff, the market expects the Fed to raise rates at least another 0.5 percentage point in September. Traders Wednesday afternoon were assigning about a 53% chance the central bank would go even further with a third straight 75% basis point increase in September. Now, that's just an estimation. We've got a whole lot of data to come through before we can say, if that's a good estimation or if it's not. It's going to change a lot. It's going to have a lot of variability. Now, the FOMC does not meet in August, but officials will gather in Jackson Hole, Wyoming for the Fed's annual retreat. So we'll have a pretty good quiet period. And the market expects the Fed to start cutting rates by next September, even though committee projections released in June show no cuts until at least 2024. Now, the Fed could start cutting rates, which would be good for equities, good for the stock market. Multiple officials have said that they expect to hike aggressively through September, then assess what impact the moves were having on inflation. Despite the increases totaling 1.5 percentage points between March and June, the June consumer price index reading was at its highest since November 1981, with the rent index at its highest level since April 1986, and dental care costs hitting a record in a data series going back to 1995. So, we understand what the Fed is doing. The Fed has faced critics both for being too slow to tighten when inflation first started to accelerate in 2021 and for possibly going too far and causing a more severe economic downturn. Senator Elizabeth Warren told CNBC on Wednesday that she worried that the Fed hikes would pose economic danger to those at the lowest end of the economic spectrum by raising unemployment. Now, I personally believe that the Fed is going to have to raise these interest rates because that's what's going to be necessary in order to be able to stop this inflation, slow down the economy, and get us back to a point of equilibrium. Now, since I went through that, what I want to do is I want to go through the stock market game plan for the remainder of this year. Okay, what is my game plan? What is my game plan? What am I thinking about? What am I looking at? And I'm going to go through this in real time with y'all to let y'all know what I'm thinking. Okay, now, first of all, the first thing I want to say is this before we even go into anything further. Continue to long-term invest. All right. Make sure you are continuing to long-term invest. Okay. You should be buying the S&P 500 every single month, dollar cost averaging, and building a position. That's what's going to allow you to build wealth over the long term. Okay. If you are a person that does research and knows how to invest in stocks, you should be buying companies that are undervalued, that have strong balance sheets, and that you can be in over the long term. If you do not quite know how to do that yet, you should be buying the S&P 500 and dollar cost averaging in a separate account and be able to manage the portfolio for yourself, right? Because if you got a 401k and you're investing into it, you're investing into some variation of the S&P 500. Okay. I also need you to know that the stock market is for everybody. Okay. The stock market is for everybody. It's not just for the rich and wealthy. Okay. This is a vehicle that is here for us to be able to build wealth. Okay. I don't want y'all to be intimidated about the stock market. I want you to understand that you can use this stock market to use the resources to really truly build the life that you want. That's why I created this brand, why I created the t-shirt. Don't pay for it, trade for it. I literally want you to go into the stock market, invest, trade for the long term, and take those profits to pay for the things that you desire. Understand that the stock market is for you. Investing is for you, right? Even if you're only investing to the S&P 500, the stock market is still for you. So please keep that in mind. Now, number two, this is the thing. Understand this. Now this is a major key. Understand that the Federal Reserve's decisions are the number one indicator for whether stocks will go up or down. Now, if you've been following me for a while now, you know that I've been preaching the Fed to y'all, understanding that the economic data is so much important to y'all. But I'm going to tell y'all why the Federal Reserve decisions are so important. It's because of this. The Fed controls interest rates. Okay, right? So if the Fed controls interest rates, what do interest rates do? Interest rates affect the ability to borrow. Now, people borrow for different reasons, right? The federal funds rate affects the ability for banks to borrow from each other, but they also affect people's ability to get auto loans, credit card interest rates, all that type of things, right? So the ability to borrow affects investors' appetites to invest for growth and meet demand. Okay, so investors are going to hesitate when interest rates are higher, because when interest rates go higher, that increases the cost of borrowing. Now, investor hesitation affects commodity prices, right? It affects commodity prices because demand is going to fluctuate, supply and demand, right? So understand this, commodity prices affect the cost of goods. Okay, so the cost of the goods that we have, the commodity prices cause that stuff to fluctuate. Okay, the cost of goods. The cost of goods affect consumer spending. If the cost of goods at the grocery store are increasing, consumers have to eat. So they're going to spend more money at the grocery store, but they may spend less money on apparel. So if that happens, consumer spending, what does consumer spending affect? Consumer spending affects companies, can affect companies' revenue and profit, right? Because if consumers are spending more or less, it's going to affect the amount of profit that it has, and company revenue and profit, and company revenue and company profit affect stock prices, right? Because if companies cannot pretty much have the amount of revenue and have the amount of profit that investors anticipate happening, that's going to affect the stock prices. So now, like I said before, I'm not an economist, but this is just a small little flow chart that I use to make it make sense to me, to kind of break it down to y'all to kind of see why the Fed's interest rates decisions can affect all of this stuff that's going on, right? The Fed's interest rates decisions can affect all this stuff, and it's in a flow chart. There's some things that you can add here, some things you can take away, but this flow chart pretty much tells you what is going to affect interest rates and why the Fed is the number one indicator for whether stocks are going to go up or down. Now, number 3, this is another major key. The Fed funds rate, right? Let's look at the Fed funds rate, right? Like we talked about earlier in the video, the Fed funds rate right now is at 2.25% and 2.5, between 2.25% and 2.5%. That's neutral policy. It's not accommodative, nor is it restrictive. But for every 1% increase in the Fed funds rate, that equates to a 10% downside risk in equities, right? Which, i.e. stocks, right? Now, let me go to the chart and let you know why this makes sense. Now, I'm finna go to the chart real quick, let you know why this makes sense, okay? Now, let's look at, now this is SPY, this is the S&P 500. Let's see what the performance has been over this year. How low have we gotten on SPY? So from our all-time high all the way down to our year-to-date low, SPY was down as much as 24.5%. So remember what I said, for every 1% increase in the Fed funds rate, that equates to a 10% downside to equities. So if we're at around between 2.25% and 2.5%, that means that the stock market has already priced in what the Fed has done to this date, right? The market's already priced in what the Fed has done to this date. Now, remember what I said earlier. I said that the Fed is not going to be having another interest rate decision until September. And so we're going to have another round of economic data, right? That economic data, we're going to get 2 inflation readings. We're going to get at least 3 job number readings, and we're going to get some other manufacturing and other economic things that's going to tell us what the Fed is going to do. Now, the Fed may reverse course. The Fed may reverse course. Also, remember, how much higher do you really think we're going to go on the Fed funds rate? Look at this chart. For my traders, remember, we're approaching a double top. The Fed may go above 3%, but we're not going to 4%, y'all. We're not. So if we did actually get to 3%, we could look at equities coming down 30%. That means that a good downside measure for equities would probably be around 30%. So that means we could look at So that means we could look at the stock market coming down to about a level of 335. Now, what does that level put us at from a long-term perspective? Let's look at the 5-year chart. Let's look at the 5-year chart and let's draw the Fibonacci, right? Let's draw our Fibonacci retracement levels. We always draw our Fibonacci retracement levels from our all-time high all the way down to a major low, right? So Fibonacci, this 335 will put us below the 50% retracement, which is really where you want to be really considering buying heavy stocks here. But understand where this 30% downside in equities lines up with. This 30% downside in equity lines up directly with an all-time high. What? The all-time high that occurred before COVID, right? It lines up directly with that all-time high. So when you look at that, a potential bottom could potentially be 335. That could be a potential final bottom. Now, we've got a lot of different risks that are going on in the economy. Inflation could continue to stay high, which could make us come down and retest this level, right? We've got midterm elections, politicians, that tends to have volatility in the market. We could come back down and retest this level. The Fed could say, hey, we're going to raise up to 3%. We're going to raise 3.5 to 3.54%. That's going to put us all the way down right here. So what I'm looking at is once we get through all this economic data through September, through October, what I'm looking at, I'm trying to navigate volatility, okay? I'm trying to navigate volatility and find good price points to purchase options contracts that expire in 2025. Now, I've got some questions in the chat very quickly. To fight inflation, would the Fed funds rate have to increase to above the inflation rate? In the 80s, Fed funds rate was nearly 20%. I do not think that is going to be needed, right? Runaway inflation, we are not in that same period anymore. Okay, I believe, in my opinion, 9.1% was the peak for inflation. If we go up a little bit higher, we will not get back to where we were in the 1980s. And the Fed funds rate does not need to get above inflation in order for the Fed to be able to tackle it. The main thing that's going to allow inflation to come down is an increase in the federal funds rate. Increase in interest rates was going to cause investors to stop borrowing, right? To pause borrowing. Also, remember commodity prices. I talked about this last week or a couple of weeks ago. Commodity prices have fallen significantly. U.S. oil, cotton, copper, wheat, natural gas, right? All these have fallen significantly, right? 26% on wheat. We're down. Okay, so natural gas is actually back up from where it was, but it was down negative 32%. But natural gas is coming back up again, and we're having like a double top. So that's one thing we need to watch. Copper, where's copper at? It's still down it's still down more than 22%. Cotton was down 11%. It's retraced a little bit, but I think it could come back down, right? Let's look at corn. Corn is still down 24%. Oil is still down 22%. So our commodity prices are down, which I believe are driving down inflation and is driving down the demand. And so I believe that eventually the supply chain issues and everything that's going on is eventually going to alleviate itself. Now, because that's very, very important. That was a great question that you asked, because a lot of people really, truly need to understand what the Fed is doing and how to play this. Now, let me go back to my note screen really quickly here. And let me finish off pretty much with what I was about to say. Now, like I said, that Fed funds rate, this is very, very key. This was something that I really didn't become conscious enough until this year. This could have saved me some money, okay, if I would have been paying attention to this and focusing on the economic data. Now, What am I looking to do? Number 4, what am I looking to do? I'm looking to navigate the volatility in the market, right? And start looking to purchase option contracts that expire in 2025. Now I know that this is mainly for my traders here, but I promise you over the next 40 to 60 days, I'm going to be giving you guys the options blueprint. Okay, I'm going to be giving you guys the options blueprint and showing you guys what I'm thinking about doing this year in terms of options. But now, right now, the stock market has had one of the worst years it's had in a long time. Okay, but I don't believe that we're going to stay this low for as long as what everybody is saying. I'm trying to purchase options contracts because I can purchase options contracts for cheaper and it can give me a better return in a shorter amount of time. And I'm trying to play out for as long as I can to allow all of these risks to eventually play out, because once we get to 2024, that's going to give me the opportunity to collect a lot of profit. Now, depending on my strategy and depending on my entries, this is giving me the ability, right, to have diversification in my portfolio. Remember what I said in rule number 1. Rule number 1, continue to long-term invest. You should be buying stocks and adding them to your portfolio. S&P 500, NASDAQ, Russell 2000, long-term companies that you've done research in, Apple, AMD, Microsoft, Google, Tesla, NVIDIA, right? Amazon, okay? That's Nike, right? Those are what you're looking at. Now, what I'm saying is for myself, I'm taking a percentage of the portfolio, and now we're navigating the volatility in the market and starting to look to purchase options contracts because the market's been down so much. Now you would say options contracts are very risky, right? What are the risks? What are the risks that are going on in the stock market right now that I believe will have been alleviated over the next 12 to 18 months, right? Inflation, right? I believe that inflation will be alleviated over the next 12 to 18 months. We're not going into runaway inflation. Eventually, inflation is going to come down. Once inflation comes down, that's going to increase investors' appetites to invest and their ability to borrow, right? What's another risk, right? The Fed raising interest rates, right? That's a risk. The Fed is going to stop raising interest rates eventually. They're not going to raise interest rates into perpetuity. When they pause and they stop raising interest rates and leave them where they are, and they start cutting interest rates, stocks are going to move higher. You heard it here first. When the Fed stops raising interest rates, when the Fed stops raising interest rates, can't type, raising interest rates and starts cutting them, stocks will move higher. I believe that's going to happen over the next 12 to 18 months. That's why I'm purchasing options contracts that are going to expire in 2025 to give me time, give me the diversification, give me the ability that I need to move and pivot and do what I need to do. Okay. What's another risk? Russia-Ukraine war, right? The Russia-Ukraine war. I believe that this conflict is going to subside eventually. It's going to subside eventually because it's just not going to last forever. And if it doesn't subside eventually, what's going to happen is the market's not going to care about it anymore. It's going to be similar to like the Iraq war when we were over in Afghanistan. Eventually, investors aren't going to care about it anymore. Like what's going on in Russia and Ukraine right now is not really affecting how the market feels about the stock market right now. Like for example, like everybody thought wheat was gonna just cripple the entire global economy from a commodity standpoint, but wheat's done fell down a lot. And so I believe the Russia and Ukraine war is eventually going to subside still. Okay, what's another risk? We talk about inflation, we talk about interest rates, we talk about the Russia and Ukraine war. Okay, supply chain issues. Supply chain issues, right? Supply chain issues. Eventually, this is going to be this is all temporary, right? It's just taking a lot of time. COVID really truly messed up the supply chain. Too much demand, too much going on. Eventually, this is going to alleviate. What's another risk that's really truly been affecting stuff, especially in China? COVID. Mandatory COVID lockdowns and other health emergencies. I think this right here is going to eventually alleviate itself as well, right? All this stuff is going to eventually work itself out and alleviate itself. Now, so the reason why I'm trying, so this is the thing. So if I'm buying options contracts in 2020, if I'm buying options contracts that expire in 2025, what I'm telling you is that before the end of this year, I'm positioning myself to go long, right? I'm positioning myself to be long the market because I understand the market is going to go back up over time. These 5 risks I've got: inflation, the Fed raising interest rates, Russian war, Ukraine, supply chain issues, mandatory COVID lockdowns and other health emergencies, and currency exchange risk, right? That's the last one I want to touch on. This is the last one, currency exchange risk. So if you look at the dollar versus looking at the yen versus looking at the pound versus looking at the peso and all these other currencies, right? These are major corporations in the United States are doing major business outside of the United States. I want to say it's between 50 to 60% of the business that United States companies, they do it outside the United States. So the thing is, the dollar in terms of currency exchange is now worth more than what other currencies are outside the United States. And so since the dollar is worth more, they're going to be using their currencies, which are worth less, to purchase our things. And then we're going to convert that over into dollars. So we're going to report earnings in dollars, but they're actually going to be less earnings because the global currency is not worth as high as what it used to be. So that's a currency exchange risk that's going on right now, but it's not something that's going to last forever. Okay, so this is my stock market game plan for the remainder of this year. These are the things that I'm looking at. These are things I'm watching. Look, the first thing I understand is that I'm going to continue to long-term invest. I'm going to continue to buy stocks because I understand that my long-term self is going to thank me later for buying stocks now. Understand the stock market is for everybody. It's for you. Okay, the stock market is for you. You do not have to know about global currency exchange risk like I do in order to be able to invest into the market. All you got to do is buy the S&P 500 every single month, allocate a portion of your budget in order to do that, and you'll be completely fine. This is not just for the rich and wealthy. When I found this tool in 2020, I found this tool and I understand that I could use the stock market to allow myself to have financial freedom. Okay, number 2, understand the Federal Reserve's decisions are the number one indicator for whether the stock will go up or down. Look at this flow chart. This is the key. This is the flow chart, understanding the price and demand. Now, like I said, I'm not an economist, but this is in general how the economy works. What's affecting what, right? If you went back into reverse and everything was going good, stock market would be going back higher. Number 3, the Fed funds rate. For every 1% increase in the Fed funds rate, that equates to a 10% downside risk in equity. So it's very, very important for you to pay attention to what the Fed is doing, how they're raising interest rates, how investors are going to take that, because we're going into September, because August is historically a good month for the S&P, but we're going into September, a historically bad month. We're going into October, which could be a weak month. And we're going to November, which we have the midterm elections, which is going to increase volatility. So I may tell you that number 4, I'm looking to navigate the volatility in the market and start looking to purchase options contracts that expire in 2025. What contracts am I looking for? I'm betting on technology. I'm betting on consumer discretionary, right? Consumer discretionary. I'm betting on semiconductors, and I'm betting on the market itself. The market itself. I'm betting on the total market. These are the industries I'm looking to be trying to purchase options contracts in, so I can get some growth in for a cheaper price and be able to maintain that. And number five, I didn't put it as number five, but for number five, understand what? The risk. What are the risks? Number five, what are the risks that I have? What are the risks that I have to navigate? These are the six. These are the major six I've got. I know we got more. Y'all can put some more in the chat if y'all want to. Inflation, the Fed raising interest rates, Russian-Ukraine war, supply chain issues, mandatory COVID lockdowns and other health emergencies, and currency exchange risk. All right. Those are the main things. So I really, truly appreciate y'all for tapping in again to another episode of the Trade for Yourself podcast. Okay. This was really, truly meant to be an opportunity to outline the game plan for the remainder of this year. Okay. Look, understand patience is key in this market. Okay. Look, we have to understand that the goal here is to build wealth. I want to help y'all build wealth over time, give y'all the tools that we need to be successful. Look, I got into the stock market because I was fascinated with the companies, right? There's a lot of earnings going on in the market right now, but I'm spending the time to tell y'all about the game plan because this is important. Like, no matter what the companies do, no matter what Apple's reporting tomorrow, no matter what Amazon's reporting tomorrow, no matter what Procter & Gamble, Exxon, Chevron, no matter what those companies report, the economy and the Federal Reserve is going to move the market. So please go through the stock market game plan. Look, I'm going to be going through certain companies over the next couple of weeks. Also understand this, we're going to be going through two major game plans. We're going to be going through the stock market. I'm going to give you guys a class on how to get into the stock market, beginners intro into the stock market, give you all the tools you need to get into the stock market. And also the options blueprint. Okay, we're going to be doing an options class, how to invest into options contracts over the long term. Okay, we're talking about leaps. Okay, we're going to go through the whole thing. I'm going to give you the tools that you need to be successful that I think will allow you to really truly have the wealth that you desire for yourself, for your family, and in the future. So as always, y'all, please like, please subscribe, and remember, don't pay for it. Trade for it.